Hi, this is John O'Day. I wanted to see if I could record a quick educational piece to send out to my clients as support. I was going through the news this morning. Today is February 5th. And as part of my educational process, as I start and orient myself to the day, I do like to check in on various news sources to try to get a feel for what my clients may be hearing or seeing. What is there information that's important to me as part of strategies that I'm going to help my clients long term in terms of executing the best processes possible to build and create wealth. And I came across an article on the front page of the Wall Street Journal that reminded me of a couple of conversations that I've had recently and this sense of frustration with what I holds to as a pretty positive resource in helping me get information. But just wanted to take you through the conversation of what I was seeing and the frustration that I was experiencing to hopefully make you a better consumer of news and information, a more critical reader, and just take you through the thought process. For context, on the day that I'm recording this, the past couple of days have been relatively volatile in the stock market. And so it is, with that context that I thought I would kick this off. So just to share some information as part of this process. I'm going to describe this as just the process of digesting the news, trying to glean the information that is important to you. What does that mean in terms of anything that you should be doing to be accountable for controlling your investment processes long term, and how to think critically about the information that you're being delivered and the sources of your information as part of this process. And again, as a reminder, if this is being forwarded to you, if you're a client, you're not a client, just as a reminder that I, as an investment advisor, I am affiliated with Raymond James. That is a process that I use to provide my investment and financial advisory support. The opinions shared in this quick feedback are mine, and not necessarily those of Summit Financial, Raymond James, or other situations. This is taken to be educational resources and not specific investment recommendations. So please turn back and rely on your investment process and the process that you're using or the professionals that you rely on to make decisions around this from a decisions making standpoint. So what I want to share is the front page of the Wall Street Journal from today and take you through this process that I experienced, and just take you through the steps. So this is a digital version of the print version of the Wall Street Journal. So if you actually got it in paper, this is what the front page would look like. And this article here would be above the fold, right? So it is a highly touted article that is considered by Wall Street Journal by implication to be something that warrants your attention as a reader. And the opportunity for the Wall Street Journal to make sure that they're engaging with their community. Some of these I have found have been really educational and data specific headlines. And I'm just starting to feel like I'm noticing that some of these headlines veer into, especially in this area where I spend a lot of time, into areas that are more triggering and less helpful. So I noticed this headline: tech sell-off propels NASDAQ to its worst 2 days in months. So I'm left with a sense that something horrible is going on, that it really warrants my attention to figure out and read through this article. And if I don't have the time and the energy and effort, what I'm left with throughout the day is the stock market is crashing. I really need to be doing something intentional about this process. Maybe there's something that I could be doing as part of my wealth management process. And as I read through the article, curious about what's going on in the process, I'm aware of what's going on in the markets broadly and the trading activity that is going on there. And I just find myself in a couple of specific areas being frustrated for people who are reading this information and the implications associated with it. So the first thing that I noticed is, um, while they are doing a good job in some areas in this article, sometimes the reader can miss some of the important factors associated with something. So worst day in 2 months in context is not helpful. From a mathematical standpoint, if you're building an investment process, you need to know the actual numbers to decide whether it's time for you to take action. So buried in here, a couple of paragraphs in, they did a really good job of just pointing out the composite posted consecutive 1% declines. And then they add for the first time since April's tariff chaos. I just want to back up 1% declines. So over long periods of time, as we are building and assembling investment portfolios, a 1% decline, I'm not sure how important that is in terms of information to take action. So it can be very common that as you are receiving information that the stock market sell-off or the index drop or something is delivered in a fashion that it's hard for you to tell how important is it. And 1% over a change in 1% over a day over long periods of time, I find in the study of building investment processes that work for people over long periods of time is almost immaterial, right? So, my first concern is the headline doesn't match the reality associated with the value change that's actually taking place. And then the rest of the language associated with is really indicative of suggesting that there's something that you must do, that if you're not taking action, you're being left out of some of the processes that are good for you. And I don't think that's true. But moves rattled investors. Okay. Um, some implication that some of the things that are going on are actually tied to this, which I don't think is necessarily true. And investors continued a week-long trend of rotating dollars out of long-time stock market superstars and funneling things into somewhere else. So um, to pause there and resist and decide what others are doing with their money, not the least of which is to try to decide, is this actually a fact-based process or part of a normal rebalance that is taking place in any portfolio reconstruction? If a certain asset class has done well over the last couple of years, you will intentionally want to decide to trim that back and buy the things that didn't do well as part of a rebalancing process. So it is not clear to me that the actual trend of rotating is something that is indicative of real information that is helpful from a wealth management standpoint. And I just want to take you through the math for a second at a very high level in a hypothetical fashion. If we were to use the data associated with this, I just wanted to share my screen and again, give you a sense from a decision-making standpoint, how important is it relative to this process? And I just wanted to share just a quick Excel spreadsheet for a second. So in many discussions that I have with investors, the process to handle periods of volatility, either up or down, generally rotates back to a question around what is your target allocation? And based on the changes that have taken place, how are you currently invested against your target allocation? And that should give you some indication of what action is required to take. So let's just imagine in a hypothetical scenario that you have a two security portfolio. You have one security that is currently worth $80 and another security that is currently worth $20. And you own them in the correct percentages because you have decided ahead of time that your investment process will benefit by maintaining an 80-20, what we call an 80-20 stock to bond ratio. Right? And I tend to find that that decision to maintain this process over long periods of time helps individuals with their portfolio management decisions in alignment with their goals and objectives. So just to pause here, if that particular security does well and it grows to 90 and the bond holds flat and is still 20, the overall value of your portfolio is now 110, but you're out of alignment from your target allocation of 80-20. You're now something closer to 85-15. So the portfolio management process would suggest that you say thank you for the growth that has taken place in that particular security. You trim it back so that your overall allocation returns to, in some capacity, 80%, 20%, or an 80-20 portfolio. That process helps you maintain rigor over long periods of time to benefit something has done well, capture the results of that growth, and know that there are other securities that may do better in different cycles. So take the winnings and rebalance over those securities that you have confidence in, but may have performed differently over that cycle. So here we have the example of what does it look like if the stock that you have followed the 1% down 2 days in a row. What would it be worth today as opposed to what it was worth on Friday? And is it time yet for relevant action to be material associated with capturing the fact that it's gone down. The value of a security when it goes down, if you believe in it over long periods of time, the fact that it's gone down might suggest that it's time for you to go buy more. So the way that it might signal to you the good opportunity that is present is to see how far, based on the changes that have taken place, how far are you from your target allocation, right? So if a large and substantial change has taken place, and we're talking 20, 30, 40% or more, then it might be true that at some point you would have the opportunity to rebalance, to sell the things that have done well or held up in value, to go buy those things that have dropped in value, so that when they do recover, you are putting yourself in a positive position. So for my filters, we got to go to a couple of decimal points to actually see that this investor is farther from their target allocation in a fashion that placing trades and taking advantage of the imbalance might actually benefit them. So I tend to find in situations like this that I really want to see that we have deviated by a couple of percent, um, more than 2%, say, from their target allocation, before the process of rebalancing tends to be in their best interest over long periods of time. So a 2% change in overall allocation, yes, it's dropped from 100 to 98, but if you run the math, the 78-41, which is 1% less over one day, 1% less the next day, so the compounding effect of those two 1% downs, right? The portfolio has dropped, but your overall allocation is still pretty close to your target. I'm not sure the process suggests that action is warranted to take advantage of the fact that other people may be frustrated and sad and selling their securities at a discount that you can take advantage of. So I just wanted to share that as a quick exercise in terms of, what does it mean? How important is it? And is there something that a high quality investment process should suggest that we follow when turbulent information is delivered to us in the news cycle? So understanding the news cycle, parsing it down to your investment process, whether you hired a professional or doing it yourself, we find that the data would suggest that there are opportunities that come up, but what is implied from an opportunity standpoint in the news cycle may not match what is an actual high quality investment process that's in alignment with your long-term goals and objectives. So I just wanted to touch on that. I'm sorry I went 20 minutes as part of the process, but I thought it was something that energized me to share and see if I could take the opportunity to help educate and level up my clients in the community associated with this process. I'm John O'Day. I'm a financial advisor with Summit Financial. I'm affiliated with Raymond James. I'm hired to provide investment and financial advice, and I hope I get to help in some capacity in the future. I hope you have the opportunity to have a positive effect on somebody relatively soon. So thank you again, and I look forward to catching up.